Get Rich Slow with John Wolf. Hey, today I want to talk to you about what's going on in the news as related to mortgages and why some things really don't make sense from the outside. Anyways, I'm a loan officer with Caliber Home Loans. There is my license info if you want to get a hold of me. And I am licensed to do home loans in Oregon and Washington. And one of the first things I want to show you is this is the mortgage-backed securities market. And I'm just going to review, if you've been watching me for a while, you've heard this spiel before, but right over here, the screen bar right here, is basically when the stock market realized something crazy was going to happen with the current public health situation. And interest rates got super low because people who normally invest money in the stock market, I'm talking big retirement funds and things like that mostly, are like, oh shoot, we want to do something safer, so we're going to do mortgages. So as they wanted to buy these, this is actually the mortgage-backed securities getting more expensive, which actually means the interest rate you pay at home gets less if you're doing a new loan. But anyways, that happened. And then right here, that was Monday, the 9th, about halfway through the day, something snapped and they realized, oh my gosh, there's way too many mortgages being written for how much that we can buy. And we think this problem might be more serious. So the value of mortgage-backed securities just went down hugely, which actually means the interest rate that lenders have to charge has to go up hugely, but that's not much of what's going on. And then these big green ups is the Federal Reserve buying, and then they stopped and they started buying again. And now the Federal Reserve is supporting the market like way up here. But this is only a small part of the story. Right now, a bunch of the zero down programs are closed, suspended, not really happening. My favorite zero down program, and this is the only one that I'm aware of that's still going on, at least in the local area, is the Washington Zero Down. And here's what they posted for pricing, just as of yesterday. They haven't updated it yet this morning. 3% interest for a zero down home loan. That's crazy. That's awesome. But it's complicated about whether or not these loans are actually going to get funded, at least the ones that are starting right now in their home buying process. If your loan's already done, you're safe. Don't worry about it. So let's just talk about that for a second. So the reason that there's a ton of turmoil in the market for making new mortgages, I'm not going to talk about the mortgages that already exist out there, is that most people are aware, many state governors have ordered people not to work, which is crazy unprecedented in the history of our country and probably most any country, I think. And then at the same time, to sort of alleviate that, the United States federal government passed a bunch of legislations. And in that legislation, they basically encourage anybody who's having any hardship to skip mortgage payments. There's a process for that. Don't just assume you can skip. You have to call in and do something. But they encouraged that basically anybody could skip their mortgage payments for 3 months by making a request. However, there's two big holes that made, or problems that caused with other pre-existing rules for the mortgage market. And those rules are, most people aren't actually aware, but I've talked about there are 3 ways of making money in the home loan process. And it's origination, kind of like the money you make by making a new financial instrument. There's servicing, so whoever sends you out your account statements and who you can call about things on your mortgage account, that's called servicing. They make some money. And then there's the investor, which is the mortgage-backed security market. Ultimately, there's a bunch of little steps in between, but that's kind of the ultimate place it goes. And if you don't make your home payment, the servicer is the person who's responsible for collecting the home payment and then sending it off to the investor. If you don't make your payment, the servicer still has to send the same amount of money to the investor. And if you can imagine, if the federal government literally tells people, or the state governments tell a bunch of people not to work, and then the federal government tells a bunch of people, hey, don't worry about making your mortgage payments, but then the servicer still has to give money to the investor, the servicers aren't running on huge margins. Kind of like a normal amount of money that those servicers make is something like 0.3% of the loan a year, which is certainly a lot of money. And that certainly adds up. But if you have to cover a decent chunk of the population not making their payment at all, that's nowhere near enough money. And then what's worse is and the reason that government loans aren't being offered by a lot of the smaller lenders, or there's a lot more rules on top of them. And this is related to the zero down program because almost all the zero down programs are on top of government loans, and every conventional based zero down program aware of was just flat out closed. And I mean, the biggest one is kind of, the advertising name from some places called Springboard. And it's a zero down conventional loan product that was available in Oregon. But anyways, it was available, and any loan that anybody who was locked, even approved by underwriting, if they weren't if they hadn't already closed on the loan, like they didn't already have the keys to the house, if they're in that process, the door just slammed shut on them and they didn't get the house. And that's awful. That's just awful to everybody involved, the seller, the buyers. But anyways, I digress. The next problem is that there are rules for home loans where the company who makes the home loan, like Caliber Home Loan, parts of it are sold off. Caliber actually keeps almost all of it, but the mortgage-backed securities might still be spun off, things like that. But if there is a default on the first payment, there are really hefty penalties for the originating lender. And by healthy penalties, I mean, if it's an FHA, a VA, or USDA loan, what happens is the originating lender has to buy back the entire loan. So like they have to buy back a $300,000 loan. And now it's also not insured by the VA or the FHA or whoever it is. So, and it can later be sold on what's called like the dinged and dented market, but we're talking about something like, 50 cents on the dollar, 60 cents on the dollar. So, for a $300,000 loan, a lender, when the client misses the first payment, could lose $150,000. And you can make a very good living as a mortgage company, but you don't make anything like that much money. I mean, I hope that's not surprising to anybody. So when you have the state governments telling people they can't work, and you have the federal government telling people it's okay to skip payments, and then at the same time you have the federal government have a very harsh rule that if a client skips the first payment, the originating lender gets slammed. That would be, I don't actually think the first payment skip rule is a bad rule, but I don't think it can coexist with an open invitation for borrowers to not make that first payment. There's also a pretty decent penalty if borrowers don't make subsequent payments, but it's not nearly as big and harsh instantaneously like the first payment. So one of the biggest factors that it will take to start for most lenders to start being able to offer government loans and these zero down loan programs is for the federal government to either, and they should probably do both of these. They set aside money for FHA loans actually, but they didn't set aside any money for any other loans. But so the federal government did set aside money for FHA loans where if a borrower defers payments, there's a kind of a loan that the servicer can get to make up those payments to pay the investor. But they didn't do that for VA. They didn't do that for USDA. They didn't do that for conventional loans. And they also didn't get rid of the penalties against the lenders for when those don't happen. Now, I totally understand anybody who would say like, hey, if you let lenders write loans and make money and then sell it to a third party and they're not penalized if the person they said could do a loan couldn't even make the first payment, they should get penalized. I totally agree with that. But it doesn't coexist in a world where people are being actively encouraged when they need to skip the payments with no penalties. It's sort of like, if there's multiple parties in this game and the penalties should be as even as possible, you can't incentivize one person to make a move that will hurt the other person. And that's basically what the current setup is. So hopefully that'll get fixed swiftly, and everything will, at least all the loans that at least should be funded that are good, decent loans, will be, and that's by all companies. I'm really glad to be working with the company I have, because we do have such deep pockets. But yeah, anyways, this was probably a pretty confusing talk. So please like, share, and subscribe. Let me know if you have any questions. Have an awesome day. Bye.